Well, good evening. Trust, we are doing great. Our class tonight, we shall be rounding up on option theory. All things being equal tonight, we should round up on option theory. For like 3 to 4 weeks, we have been on this topic, option theory and valuation. Let us do a recap of our last discussions or a recap of our previous discussions. We explained that option market is an emerging market. Just as you have the stock market is a market where you buy and sell stock. The stock market is a market where you can buy shares or you can sell shares. We also have the bond market. The bond market is a debt market where you can buy or sell debt securities. We have the foreign currency market. The foreign currency market is a market where you can buy or sell foreign currency. In recent time, we have an emerging market. The emerging market is the option market. Option market is a market where you can buy or sell options. Option market is a market where you can trade on options. You can buy options, you can sell options. What is option? We define option as the right, but not the obligation, to buy or sell an underlying asset. The option market is a market where you can buy, you can obtain the right to buy, or you can obtain the right to sell an underlying asset at a pre-specified price. The underlying asset could be stock, shares, bond, or foreign currencies. We explain this. To buy or sell, to obtain the right to buy or sell, you must pay a premium. This premium is the amount paid. The amount paid to obtain the right to buy or the right to sell. This right to buy is known as the call option. while the right to sell is known as the put option. The premium payable on the right to buy is what we call premium or price or value. The premium payable on the right to sell is what we call the put premium or the put price or the put value. This premium must be paid before you can obtain the right to buy or the right to sell. This premium is non-refundable. Whether you exercise your rights or not, the premium will not be refunded. To calculate this premium, we can use the Black School model. The Black School model is a mathematical model that can be used to calculate the price of a call option or the price of a put option. We can use Black School model to calculate the premium payable. We explain this. We now look at the application of option theory to investment appraisal. You can use the concept of option theory to value capital investment projects. The option theory allows us to value financial flexibility available in capital investment projects. We discussed this under 4 headings: option to abandon, option to delay, option to expand, and option to switch. And we are able to solve questions on these variables. Tonight, to round up our discussion, we shall be looking at the application of option theory to business valuation. Tonight, we shall be looking at the application of option theory to business valuation. Precisely, we shall be looking at the use of Black School model for equity valuation. How can we use Black School to value equity? The first question is, what is equity? We all know equity. Equity is the amount of money contributed to the business by the owners of the business. We stop at option to expand. Meaning that we have not done option to switch. If I'm interpreting you right, we stop at option to expand. That means we have not applied question to option to switch.
Yeah, good evening, sir. Yes, sir.
And I remember very well that, please, can you mute? I remember very well that I said option to expand and option to switch follow the same principles. Examiner will always test question. Whether you are dealing with option to expand or option to switch, it represents the same principle. Now you can speak. And please, if you want to speak, particularly if you want to unmute your speaker, please signify by raising up your hand, so that we can have it, we can maintain a decorum in the classroom. Yes, any clarification, please? Yes, any clarification? All right. So please, do not be under the impression that we do not have a plan for the class. If you go through ICAN past question, you are not going to see any question on option to switch. If you go through a CCA question, no question on option to switch, because option to switch is the same as option to expand. We have a plan for your exam. All right. We are looking at valuation of equity. Yes, it's fine. All right. Let's go on to with the class. We had a light out, so I don't need to put on my agenda. Now, I was trying to explain equity. Equity represents shareholders' value. Equity represents shareholders' wealth. Now, the question is, how do we value equity? To the firms, or to the company? Equity represents a residual claim. What is residual claim? The equity holders will lay claim to all the cash flows after the company has settled the financial claims of other stakeholders. Equity shareholders, we have access to all the profit in the company after you have settled the debt holders, you have settled preference shareholders. Any profit remaining belongs to the equity shareholders. Hence, equity represents a residual claim. If a company is liquidated, the same principle is applied. The equity shareholder will receive claim last if a company is forced into liquidation. In the process of distribution, that is, a company is liquidated, the assets of the companies were disposed. If you are trying to distribute the money realized on disposal, equity holder will receive money last. That is the concept of limited liability. The limited liability principle protects equity investors. The limited liability principle protects equity investors in quoted companies. How? If the value of the company is less than the value of the outstanding debt, if debt value is more than the value of the assets, that means the company is troubled. Please listen to this. The total value of debt is greater than the total value of the asset. That means the company is in financial crisis. If your debt value is more than your asset value, that means that company is in financial crisis. At this point, limited liability principle protects equity shareholders. They can only lose the amount the company has invested in the business. The shareholder can only lose the amount they have invested in the business. Hence, if the value of debt is more than the value of assets, the equity shareholder has a choice. They have the options to walk away from the company. Look at the concept. Where the value of debt is more than the value of assets, the equity shareholders, that is the owners of the company, have a choice or the options to walk out of the company. Alternatively, if the asset value is more than the debt value, that means the company is financially viable. Where your asset is more than your liability, that means the company is financially profitable. In that case, the shareholders will continue to run the business so as to benefit from the surplus. Given this concept, value of equity, given this analysis we have explained, the shareholder has the option to pull out of the company where value of debt is more than the value of equity. There's option to pull out. Therefore, the value of equity can be seen as a call option. A call option owned by the shareholders. The shareholders have the option where liability is more than assets to pull out of the company. Hence, you can value your equity as a call option owned by the shareholder. That is, the shareholder has obtained the right to buy into the company. If this right is profitable, if the company is profitable, the shareholder will continue to run the business so as to benefit from the profits. But if the company is in financial crisis, if the company is in financial crisis, the shareholder has the option to abandon the company, to pull out of the company. Because the principle of limited liability states that the liability of the shareholder is limited to the amount invested in the business. The principle of limited liability states that the liability of the shareholders is limited to the amount invested in the business. Hence, this principle protects equity shareholders. You cannot lose more than the amount you have invested in the business. Hence, if liability is more than assets, the shareholders cannot be called upon to come and contribute more money to the business. Given this scenario, we can value equity as a call option. That is, the value of the call option will represent the value of your equity. Now, to use call option, to use the black school model, we require the 5 input variables. To use the black school model, let me check here. To use the black school model, you require the 5 input variables. What are these variables? Your XO. Your XO is the underlying asset value. Your capital letter E, the exercise price. Your letter T, time to maturity. Your small letter R, your risk-free rate, and your volatility, represented by your standard deviation. Now, if you are to value equity, these 5 input variables are represented with the information below. Your XO is total asset. Let me correct this. Your XO is total assets less current liability. If you are to use Glasgow to calculate value of equity, your XO is represented as your total assets minus current liability. Your capital letter E, the exercise price. The exercise price is your outstanding debt, long-term debt. Your exercise price is calculated as present value of long-term debts. Please note, the debt is assumed to be a zero coupon debt. Theoretically, your debt is assumed to be a zero coupon debt. This is the most sensitive area of this calculation. For this valuation, determining the exercise price is the most tricky. The assumption is that the debt will be a zero coupon debt. What is zero coupon debt? A debt that will not pay interest. What is zero coupon debt? A debt that pays no coupon interest. If you are given a coupon paying debt, then you are going to adjust that coupon paying debt so as to achieve an equivalent zero coupon bond. When we get to a question, we try to explain more. Calculating the exercise price is the most tricky. Other variables, you can get it easily. Your risk-free rate is the interest rate on government bond or government debt instruments. Time to maturity, that is the maturity of the long-term debt. While your volatility is the standard deviation. Once you are able to get these 5 variables, then we can calculate our core value. Value of the call option will represent value of the equity. All right. As much as possible, let us try to follow the illustration. We can explain more. All right, any question? We shall be starting with question number 3. Please refer to your study pack. Liverpool PSC. Please refer to your study pack. Illustration 3, Liverpool PSC. I'm trying to expand this. Yeah. Are we good to go? Are we good to go?
Go ahead, sir.
All right, let's move to this question. Liverpool PSC is undertaking a due diligence investigation of Amazon PSC and is reviewing the potential bid price for acquisition. You have been appointed as a consultant to advise the company's management on the financial aspects of the bid. So you have been appointed as a consultant. Advise us on the financial wholly by equity, the finance, in an effective investment market. Both companies have been trading strong levels of profitability recently. However, both company shares please note that both company shares are thinly traded. It is thought that the current market value of Amazon shares at 33.13%, 33.1/3% higher than the book value is accurate. Let me explain that. It is thought that the current market value of Amazon equity at 33.1/3% higher than the book value is accurate. But it is fact that I need to change this. Anywhere you have K, the name should be Liverpool. But it is fact that Liverpool shares are not quoted accurately by the market. Anywhere you have K, please, that should be Liverpool. It is fact that Liverpool shares are not quoted accurately by the market. The following information is taken from the financial statements of both companies at the beginning of the current year. We have Liverpool PSC, Amazon PSC. We have the asset less current liability. We have capital employed equity, equity of Liverpool, the book value, 88 million. Equity of Amazon, the book value, 24 million. 5-year floating rate loan, yield rate plus 3%. Liverpool is not financed by debt, but Amazon has a debt that's worth 60 million. A floating rate loan, that is loan, worth is 60 million. This loan is for 5 years. The floating rate is yield rate plus 3%. Then we have total capital employed. Next, we are giving the net operating profit after tax. For Liverpool, 11.6 million. For Amazon, 8.6 million. Next, we are giving net amount retained for reinvestments in assets. We have the values. Next paragraph. It can be assumed that the retained earnings for both companies are equal to the net reinvestment in assets. Next, the assets of both companies are stated at fair value. Discussion with Network Bank has led to an agreement that the floating rate loan to Amazon PSC can be transferred to the combined business on the same terms. The current yield rate is 5%. And the current equity risk premium is 6%. It can be assumed that the risk-free rate of return is equivalent to the yield rate. That means our risk-free rate is also 5%. Liverpool PSC, beta. Liverpool PSC beta has been estimated to be 1.26. Next paragraph. Liverpool PSC want to use the Black School's option pricing model to assess the value of the combined business and the maximum premium paid to Amazon's shareholders. Liverpool PSC has conducted a review of the volatility of the combined business assets. If the acquisition were to go ahead, will be 35%. Volatility of the combined business assets, if the acquisition were to go ahead, will be 35%. The exercise price should be calculated as the present value of a discount zero coupon bond with an identical yield and terms to the maturity of the current bond. Something like this was texted as compulsory question in, if I'm not mistaken, I think 2023 November dies. Something like this was texted for 30 marks. Valuation of equity using Black School model. I think November 2023 or May 2024. That was the compulsory question for 30 marks. If you are faced with questions of this nature, how do we navigate? Look at the requirements. Because this question is business valuation. Liverpool PSC want to acquire Amazon PSC. Just like saying Access Bank acquired Diamond Bank. For Liverpool to acquire Amazon, there must be a price that Liverpool will pay for the acquisition of Amazon PSC. There must be a price that the acquirer will pay to acquire the target company. Now, requirements A. Using the free cash flow model, estimate the market value of equity for Liverpool PSC, explaining any assumptions made. So, we want to determine market value of equity. Examiner specify this using free cash flow model. Now the question will be, what is free cash flow model? What is free cash flow? You are still going to take this as a topic. When you get to business valuation, Adejuwon will take you through this process. But let me explain briefly. What is free cash flow model? Free cash flow is the cash flow available to equity shareholder. Sorry, free cash flow available after we have deducted operating expenses, after we have deducted taxation, after we have paid interest to debt holders, after we have made provision for reinvestment in assets, the balance remaining is referred to as free cash flow. Now, the balance remaining is classified as free cash flow. Now, there are two types of free cash flow. We have free cash flow to firm, and you can have free cash flow to equity. There are two types of free cash flow model. You can have free cash flow to firm, or you can have free cash flow to equity. If you are required to value equity, please just 1 minute. If you are required to value equity, the appropriate free cash flow to use is the free cash flow to equity. That is cash flows available to equity shareholders. That is the cash flows available to equity shareholders. We can now go to this. Examiner says you must explain your valuation assumptions. Examiner says we are going to explain your valuation assumptions. Let us go to this. We can calculate market value of equity as the present value of free cash flow to equity using the cost of equity as our discount factor. To value equity, we can use Gordon growth model. Remember Gordon growth. Your free cash flow to equity is the cash flow available for dividend payments. You can use Gordon growth model. Your free cash flow to equity is that cash flow available for what? Dividend payments. Recall Gordon growth model. Value of equity for Gordon growth. If you remember, value of equity, if you are using Gordon growth, value of equity is equal to D bracket 1 plus G over KE minus G. We only remove D. That will equal to your free cash flow to equity. The free cash flow available for dividends after we have deducted operating expenses, we have paid interest to debt holders, we have paid taxation, we have made provision for investment in assets. We can use this valuation model. You can now return your free cash flow. Let us go to Liverpool. Look at Liverpool. Net operating profit after tax, 11,600. Your profit after tax implies that you have settled operating expenses. You have settled interest expense. You have settled tax liability. You now have your profit after tax. Your profit after tax is profit earnings attributable to shareholders. Out of this money, net amount retained for reinvestment in assets. Out of our profit after tax, we are going to retain 3,600. What is the free cash flow? You can compute.
10,000.
10,000 K. How?
8,000. 8,000, sir.
Oh, 8,000. Thank you, sir. Look at it. Our free cash flow, no parts. That is net operating profit after tax, 11,600 minus reinvestment in assets, 3,600. This will give me 8,000. This is free cash flow to equity. You have gotten your free cash flow to equity. Look at the formula we are planning to use. We have computed free cash flow to equity. Next, growth rates and cost of equity. Let's go to this. To calculate cost of equity, there are two methods you can use. You can use dividend valuation method, or you can use the ICAN method. The method you are going to use is a function of the variables you are given in the question. The method you are going to use is a function of the variables you are given in the question. Just 1 minute. Let's continue. If you look at the question, you have beta of 1.6. You have equity risk premium, and you are giving the risk-free rate 5%, equity risk premium 6%. Our beta is 1.26. We can use this variable using ICAN method. Using ICAN, cost of equity is equal to RUF, risk-free rate 5, beta 1.26, equity risk premium, that is RUM minus RUF is equal to 6. Please compute your cost of equity. %12.56%. That is the cost of equity. Then the growth rate. Please note, examiner will not tell you whether there is growth rate or not. The examiner will not tell you whether there is growth rate or not. It is you that will figure out if there is growth rate. How do we figure this out? Once you have retained earnings, once part of the profit is retained, then you can estimate growth rates. Once there's retained earnings in the question, then you can estimate the growth rates in earnings using Gordon growth model. Look at this. For Gordon growth model, our R is equal to return on equity. It's also equal to cost of equity. We have calculated this is equal to 12.56%. Our B is retention ratio. That is, your retention ratio is calculated as let me expand this more. One more. All right. Our retention ratio is equal to retained earnings divided by your profit after tax. Our retained earnings is 3,600. Profit after tax, out of profit after tax, 11,600. We retain 3,600. Please compute your retention ratio. Please compute your retention ratio.
31%.
31.03%. Is that correct?
Yes, sir.
Now you have gotten your retention ratio. You can now calculate growth rate. G is equal to R 12.56% multiplied by 31.03%. Please, what is the growth rate? You are going
308.
to get
389.
0.39.
Yes.
If you calculate correctly, that is equal to 3.9%. If you have calculated correctly, that will be your value. Any question, please?
You are correct, sir.
What we do is just walk people out based off trust. Now I trust that our base could be wrong, and I'll find out and get it.
If there's no question, we can move on. Market value of equity is equal to Free cash flow to equity 8,000. Bracket 1 plus the growth rate 0.039 divided by cost of equity 12.56%, 0.1256 minus the growth rate 0.039. Please, what is the value of this company equity?
Very smart. So I really go for smart player. Very good at stuff. We know it's a challenge. It's very
Please, can you mute? Whoever is disturbing us.
Thank you.
Mr. Tisla, your background is disturbing us.
Husseini, please, can you mute? We have external interference. That means your TV is on and the noise is conflicting with the class. All right, final answer. Number 680, okay.
95.98.
95.
0.98 or approximately 96.
All right, that's great. 95,981. Value is 95,981.5. If you want to approximate to the nearest million, that will give me 96 million. So the nearest million, the equity value of Liverpool PSC was 96 million. We have addressed requirements A. What are the assumptions made? Look at the assumptions. We have calculated the market value of the equity of Liverpool as an independent company. Liverpool market value was 96 million. Look at the assumptions. One, we have assumed that there is a constant growth rate. The growth rate is constant at 3.9%. And retained earnings can be invested at the cost of equity. Remember, Liverpool is all equity finance. So we have assumed that we can reinvest our retained earnings at the cost of equity. Assumption number two, the cost of equity remains constant to infinity. That cost of equity, 12.56%, will remain the same forever. Then assumption. Number 3, assumption. Is okay. The company is assumed to be a going concern. That is, Liverpool is a going concern company. There is no threat to the existence or to the continuous existence of Liverpool. We have assumed that the company will be in existence and continue to operate business. And the market value represents the present value of future cash flows to infinity. Any question, please? If there's no question, let us look at requirement B. Requirement B says, explain the circumstances in which the Black School option pricing model can be used to assess the value of a company, including the data required for variable use in the model. The question is, when can we use Black School model to value company? I will explain this briefly. We have the traditional business valuation method. We have the traditional business valuation method. This includes asset valuation method. You can value a company based upon the company's assets. We also have the income valuation method. You can calculate value of a company on the basis of income generated by the company. You also have the dividend valuation method, and you have the cash flow method. This method we have mentioned are classified as the traditional business valuation method. As an alternative to the traditional method, we can also value company using option theory. As an alternative to the traditional business valuation method, you can also value company using the Black School option pricing method. What are the circumstances where you can use Black School? Where the traditional method will not fully reflect the risk of the company, then you can use the option pricing method to value the company. Where the traditional method do not fully reflect the risk involved. Then we can adopt the Black School method, the Black School option pricing model. All right, let us go to the explanation. Excuse me, please. Look at requirement B solution. The Black Schools option pricing model. The Black School option pricing model provides a basis for corporate valuation in situations, in cases where traditional methods are either inappropriate or where they do not, or where they fail to fully reflect the risk involved. You are going to use Black School method in situations where the traditional business valuation method are inappropriate or they do not fully reflect the risk involved. Given the gearing of the two companies, if you look at the two companies, the gearing level differs. Liverpool is not geared. Liverpool is not financed by debt, while Amazon is financed by both equity and debt. You now want to value two companies. You want to value Liverpool, an ungeared company, and you want to value Amazon, a geared company. That means the gearing of the company, the risk is not the same. Given the gearing of the two companies, the low level of trading in each company's equity. So look at this. The question says, both company shares are thinly traded. Low level of trading in each company's equity and their future growth potential, including volatility. It is appropriate to handle the valuation by focusing upon the real option value, given that the risk of the companies are not the same, and the level of trading in the company shares are low, including the volatility they are exposed to. It is more appropriate to focus on the real option value. Hence, it is more appropriate to value this company using Black School's option pricing model. We have explained the reason. Part of the question says, including the variables required for valuation. What are the determinants of the valuation? Look at the comments. The usual determinants in the valuation of options need to be redefined when the valuation written by the lenders on the underlying asset of the business. What are these determinants? The underlying assets, that is your XO. Our XO is what? Total assets less current liability. Number two determinant, the exercise price. The exercise price is settlement values of outstanding long-term liability. That is the present value of long-term debt. Next, volatility of the underlying assets. That is the standard deviation of the underlying assets. Next, the risk-free rate of interest. That is the current yield on corporate companies' debt. Then the time to maturity or time to expiry. The time to expiration is the average time to settlement of company's liability. These are the variables required for valuation. You can go on and on to read, but we have explained the main points. This will address requirement B. Requirement B is just explanation. We now move to requirement C. Look at requirement C. Examiner says, using the Glasgow's option pricing methodology, estimate the maximum price and premium Liverpool may pay. This should be may pay, not mine. Estimates the maximum price and premium Liverpool may pay for Amazon using a school model. What is the maximum price Liverpool will pay to acquire Amazon PSC? We need to explain this more. Before acquisition, Liverpool was 96 million. Look at the calculation. Oh, excuse me, please. Before acquisition, Liverpool as a company was 96 million. We now try to calculate post-acquisition value of Liverpool. What is the value of Liverpool after acquiring Amazon? We are now going to have post-acquisition value of Liverpool. The difference between value of Liverpool after acquisition and value of Liverpool before acquisition will represent the maximum price Liverpool will pay to acquire Amazon. Is that explanation clear? Is that explanation clear? Let us go to the computation. Excuse me, please. Maximum price and premium. Valuation of the combined business assets using Black-Scholes model. Valuation of the combined business assets using the Black-Scholes model. All right, please, just 1 minute. Continue. Continuation. All right. Trying to clean my hand. There's water in my hand. Remember, if you are to use Black-Scholes to value company, you are going to treat it as a call option. We now come here. Time to maturity or time to expiration. What is the maturity of the company's loan? Long-term loan. Let's go check. That will be your time to maturity. Look at the question. Please look here. 5-year floating rate loan. That means the loan will mature in 5 years. The maturity of the loan is in 5 years. Please note that. Look at the combined assets. Asset less current liability. For Liverpool, 88 million. For Amazon, 84 million. Please sum this together. The debt is 60 million. 88 plus 84.
170.
That will give us 172 million. If I come here, our XO, total asset less current liability, for the combined business, 88 plus 84. That will give me 172 million. Time to maturity, 5 years. The loan will be repaid in 5 years' time. Volatility, examiner says 35%. The risk-free rate, that is your current yield. This is 5%. The exercise price. This is where we are going to do small working. Our exercise price is the present value of the long-term loan. Our E is the present value of long-term loan. The amount of the loan is 60 million. We are going to repay this loan in 5 years' time. We are going to repay 60 million in 5 years' time. What is the present value now? The loan is 60 million. Maturity, 5 years. What is the interest rate on the loan? The interest rate, examiner says yield rate plus 3%. It's a floating rate loan. The yield rate is 5%. The yield rate is 5% plus 3%. That means the interest on this loan is 8%. We are going to repay 60 million in 5 years' time at an interest of 8%. What is the present value of the loan now? We have to discount this loan to its present value. We have to discount this loan to its present value. Look at it, please. The present value is equal to amount of the loan multiplied by 1 plus R. Our R is the interest rate, 8%, 0.08. Raised to power minus N. N is 5 years. You can now come here. Please work this out. 60 multiplied by 1.08 raised to power minus 5. What is the present value of the loan? 40.835 million. That is the present value of the loan. The loan we are going to repay in 5 years' time. The amount is 60 million. What is the value now? 40.835. That represents our exercise price. May God give us a better understanding. If your syllabus is correctly tested, you are going to be facing questions on advanced strategic financial management. And you are going to expect more of questions from options, currency hedging, all right. Only God knows what will be tested. You have gotten the 5 input variables. Value of call. The formula for call option is stated. We need to calculate D1 and D2. Formula for D1, look at it, don't forget. Our D1 is equal to in bracket XO divided by E, close your brackets, plus, open another brackets, R plus 0.5 volatility square, close your bracket, multiply by T. Everything divided by volatility square root of T. Please compute your D1. Our D1 is equal to in bracket XO 172, capital letter E 40.835, plus, open another bracket, my R 0.05 plus 0.5 multiplied by 0.35 raised to power 2, multiply by 5, number of years, everything divided by volatility 0.35, multiply by the square root of T5. Please compute your D1. Please compute your D1. Apply your calculator and calculate your D1. I have into brackets 172 divided by 40.835, close my bracket, plus, open another bracket, 0.05 plus 0.5 multiply by 0.35 raised to power 2, close my bracket, multiply by 5, then divided by 0.35 multiplied by the root of 5. Final answer. I have 2.5481.
2.5481.
That's great. My D1, 2.5481. And don't forget, you have to comply with ICAN position. You are going to work to 4 decimals and D2. Next, compute your D2. D2 is equal to D1 minus volatility square root of T. Our D2 is equal to 2.5481 minus 0.35 multiplied by the root of 5. You can put this in brackets. What is your D2? $1.7655. My D2, 1.7655. When you are done, determine ND1 and ND2. Determine ND1 and ND2 using normal distribution table, subject to 0.5 plus or 0.5 minus. You now pick your D1. My D1 is 2.5481. Establish a range. The range is between 2.54, 2.55. That is the range. Then go to your ND1. You have a positive sign here, 2.5. Start with 0.5 plus. Open a bracket. Move to your log. 2.5 trace to 4. Where is the log? Look at the log, please. 2.5. I will trace it to 4. 0, 1, 2, 3, 4. That gives me 0.4945. And the next is 0.4946. I require the 2. 0.4945. So I have 0.4945. We have checked 2.54. We are left with 0.81 plus 0.81. Open another bracket. Now go to the log. 2.5 trace to 5. That will give me 0.4946 minus what you have normal log here minus 0.4945. Please work this out. Put your N1. Please work this out. Final answer 0.9946.
Correct.
ND1 0.9946. When you are done, go to your ND2. Pick your D2. 1.7655. Establish a range. This number range between 1.76 and 1.77. There your ND2. You have a positive sign here, positive 1.7655. Then you are going to start with 0.5 plus. Open a bracket. Let us go to the log. 1.7 trace to 6. Look at it, please. 1.7 trace to 6. I can take it off small. No, it's too much now. Yeah, look at it. 1.7 trace to 6. This is 3, 4, 5. This is 0.4608. And trace to 7, 0.4616. You can return to the solution page. Here I have 0.4608. We have checked 1.7 trace to 6. We are left with 55 plus 0.55. Open another bracket. 0.7 trace to 7. That will be 0.4616 minus 0.8. Please work this out. What is our ND2?
$0.9612.
Oh, thank you. Our ND2, 0.9612. You can now your value of call. Remember the formula. XO multiplied by ND1 minus capital letter E exponential raised to power RT multiplied by ND, our XO multiplied by ND1 0.9946 minus our E 40.835 exponential negative our R 0.05 multiplied by 5, your T number of years, everything multiplied by 2, 0.9912. Please work this out. What is your core value? Work this out. What is the of call option? Final answer 140 million points what, please? Yes, final answer.
140.50.
Yeah, that's great. 140.50 million. That means value of Liverpool after acquisition post acquisition value of Liverpool is equal to 140.5 million. Before acquisition, value of Liverpool is equal to 96 million. Therefore, maximum price payable. Maximum price payable to acquire Amazon PSC. Difference between the two, please.
44.5.
That is the maximum price Liverpool will pay to acquire the entire equity shares of Amazon PSC. That is the maximum price Liverpool will pay to acquire the entire equity shares of Amazon PSC. Using Black School option pricing valuation. Any question, please? If there's no question, then what is the premium payable? If there is no question, the examiner says calculate maximum price and premium. We have calculated the maximum price. Liverpool may pay to acquire Amazon. The next computation is, what is the premium payable? Let us explain this. What is premium? What is the premium? Payable on acquisition. This is different from the premium on option theory. Please don't confuse the two. What is the premium payable on acquisition? Let me illustrate with a more elementary example. Assuming Mr. A want to marry Mrs. B, Miss B. Mr. A want to acquire Miss B. Before acquisition, Mr. A will value himself. Let us assume Mr. A worth 100 million. The man that want to marry worth 100 million before marriage. After acquisition, the two of them must worth 150 million. After acquisition, the two of them must worth at least 150 million. Now, if Mr. A, ordinarily, Miss B worth 50 million, that means Mr. A should have paid 50 million to acquire Miss B. If Mr. A is willing to pay 75 million, knowing fully well that Miss B worth 50 million, if Mr. A is willing to pay 75 million to acquire Miss B that worth 50 million, the premium payable is the extra amount over the value of the target. That premium payable is 75 million minus 50 million, 25 million. That is the additional amount paid over the worth of the target company. Now, back to the question. If we want to calculate premium now, we now ask ourselves, Liverpool is willing to pay 44.5 million maximum. You now ask yourself, what is the value of Amazon? Even though I'm willing to pay 44.5 million maximum, what is the equity value the equity worth of Amazon PLC. We want to know the value of Amazon now. Even though I want to pay 44.5 million, how much does Amazon PLC worth? Examiner gave us a clue. The examiner gave us a clue. Let's go back to the question. Examiner says, look at it, please. Examiner says, let's go up small. Yeah, look at it. It is taught, paragraph 2. It is taught that the current market value of Amazon shares at 33, 1/3%, higher than the book value is accurate. That means the current market value of Amazon is 33.13% more than the book value. What is the book value of the company's equity shares? Look at it, please. Examiner says equity. The equity value of Amazon, book value 24 million. Why the market value is 33.13% higher than the book value? So what is the market value? Let's go to this. Calculation of market value of Amazon shares. Examiner says book value of equity. That is Amazon now. 24 million. Market value of equity is 33.13% higher value. Please, what is the market value? 33.13% more than book value. You can do this like this. What do you have? Has anybody computed? Yes, sir. What do you have?
I got 8,000, then plus 24, that's 2,000.
Correct. That's correct. The market value of equity of Amazon is 32 million. To the nearest million. Look at the computation. %100 plus 33.13%. That will give me one. You can now do like this. Multiply by 24 million. To do this house, you are going to have $1.33333. It will go like that. So if you convert percentage to ratio, 1.3333333, multiply it by 24 million. That will give you 32 million. That is the market value of equity shares of Amazon PSC. When you are done with that, get the premium. Amazon was 32 million. And Liverpool is prepared to pay maximum of 44.5. Therefore, the premium. The premium, look at it. Premium payable to acquire Amazon is maximum price, maximum price, 44.5 minus less market value of Amazon equity, 32 million. Please, the difference.
12.5.
That is the premium paid. Extra amounts Liverpool is willing to pay over the value of Amazon. The extra amounts Liverpool is willing to pay over the current market value of Amazon equity represents the premium paid. Who is completing the class? Augusta.
Sorry, sir.
The last requirements. If there's no question on the last requirements, please Let us avail ourselves this online opportunity. The demand for online class is more challenging. Could be a cooler. But you can pass your variables very well. Your variables, if you're able to manage them very well. All right. The last requirement, discuss the appropriateness of the method used in Part C above, and considering whether Black School model can provide meaningful value for a company. The question is the valuation method appropriate? Can Black School model provide a meaningful valuation for company? Look at the comments here. The Black School model is based on many assumptions, and the model should be expected to provide an indication of value, not the exact or definite value of a company. Black School model cannot provide meaningful valuation. It can just provide an indicative value. We can only expect Black School to provide an indication of value, not the exact or definite value of a company. The model is applicable only to European options. That is, option can be exercised only on the maturity date. This debt must be repaid in 5 years. Any attempt to repay the debt before 5 years will affect our valuation. Any attempts to repay the debt within 5 years, it must be at the end of year 5. It is assumed that value of the assets of the business change randomly around a rising trend and are thus log normally distributed. The simple conclusion is that Black School model cannot provide appropriate or accurate valuation. It can only give you an indicative value, not meaningful value. That takes us to the end of that question. Oh, any question, please? If there's no question, we can stop the class here tonight. May God enrich us in knowledge. Let's have a blessed evening. Good night, all.
Thank you. Good night, sir.